Welcome back. We start off this segment still here in Nigeria as the Director General of the Debt Management Office, Patience Oniha, wants the investing public to know that the federal government is committed to reducing the cost to debt service ratio of the nation. Speaking on government's plans to manage the 10.7 billion naira green bond offering, Oniha explains how the external borrowing strategies will address that.
Yes, we are also looking at how we can sort of manage the debt so that the debt service numbers are lower. So one of the major strategies really is why we're also accessing the external markets, because the cost of borrowing there is significantly cheaper than what it is in the domestic market. With the exception of this week's auction, and my colleague Afolabi is extremely pleased with the auction result. You will know that there's a difference of about 10% between borrowing in the domestic market and externally. So I'll give you an example. The 30-year bond, Euro bond, we raised it at 7.625%. Okay, in Nigeria, even for our 10-year bond, before this week's auction, in fact, if you look at Q3, let's not even look at Q4, we're borrowing in some instances at almost 17%. And for treasury bills, with a discount rate of 18, you're talking of an effective cost of about 22%. So we needed to also see how we could bring down debt service. That explains also why we're looking at the external. Okay, so some people ask, if you are going to borrow externally, aren't you assuming a foreign exchange risk? We tell them we have a natural hedge. We earn, our revenues are in dollars. But more than that, there are various efforts being made to increase our export earnings. Okay, so there is an export drive, but also an import substitution drive. So that will reduce the demand for foreign exchange going forward. If we, as we know, stop importing rice, wheat, and the several things that we import, we know that the demand for foreign exchange should drop. So both ways, working on both sides in managing the demand and the supply side of FX, we expect the exchange rate to be stable. That is if it doesn't get better. And we're already beginning to see foreign investors come back to the FGN securities market. So supply on all sides are increasing. So I want to assure you that in managing the public debt, we're considering various sides. We're not just sitting and each time you see us in an auction, you say they've come again. No, there's a strategy around all of that, and we are conscious of the debt to GDP ratio, the debt service to revenue ratio, as well as the foreign exchange risk.
And the currency volatility that dovetailed into 2017 from last year still has its tolls on the investment space. One of the sectors reeling from that effect is the hospitality sector. Channel's business news producer Temple Ashaju spoke with the chief executive of Nigeria's stock exchange-listed Transcorp Hotel, Mr. Valentine Ozibo, who narrated how the high FX regime is impacting the Lagos project.
Apart from also what we do in Abuja, the Transcorp in Abuja, and the Transcorp Hotels Calabar, we are obviously expanding. Lagos being our major target. We already started the foundation works and slowed down a little bit, but the momentum is still there to make sure we drive completion in the foreseeable future. And beyond Lagos and the other two locations I've mentioned, Port Harcourt is also an area of emphasis for us, and eventually in other parts of Nigeria. So in all of these, some of these locations, we've acquired the land, we've done the designs, and the preliminary works are ongoing. So we intend to eventually be what I call the owner of choice premium assets when it comes to real estate. Similar to what we have in Abuja, we want to be able to replicate those successes in the other locations. And Lagos in particular has been beckoning for our coming.
When are we looking at kickstarting? Because you actually referenced the slowdown. And we know Transcorp Hotel had its IPO a few years ago. I think investors will actually be looking forward to, let's say, the foundation level, let's say where we're moving to.
Yes, the reality is that focus shifted a little bit because we needed to make sure the upgrade on Abuja is advanced while we monitor the momentum in Nigerian economy. Now, speaking about the upgrade, we have spent $100 million and still in progress in taking the hotel to the next level. I'd like to invite you to see what we've done in Abuja. We've done half of the floors now, and we're going down to the rest of the floors. And materials and things we need for the rest are actually either on ground or being finalized. Now, if you go back to our plan for Lagos, by now we should have been faster than where we are. Progress started. There are a few approval and land issues that we had on the way, which actually are now being sorted, finalized, and that will create opportunity for us to advance progress. But I also like to say that the way the economy actually had veered, when you talk about the issues being discussed today, FX movements, and the fact that the cost of delivery has gotten so high, we also had to make sure we look at the feasibility, the numbers, to be sure they make sense at the exchange parity. So all of that is also coming on, because in the end, our objective is to deliver true value to the investors. You don't want to also build aggressively. Imagine if we had through our development when it was 500 naira per dollar. We would be crying today. I mean, we would have destroyed value. So you need to create balance that allows you to make progress, to make sure you're not starting a company, but at the same time, monitor the direction of things. We feel that even though official rates about 3.0 to 3.04, 3.05, and power market about 360, 360, which source you look at, we feel there's still a lot of room for improvement in that regard. So you need to weigh your options carefully, but at the same time, we're mindful of the time that we need to deliver on the new projects.
And finally, Angola's government expects the country's economy to grow 4.9% next year. The country's budget, which still needs to be approved by lawmakers, forecasts a fiscal deficit of 2.9% of GDP in 2018, with government revenue and expenditure of 9.6 trillion kwanza. The 4.9% growth forecast is well above the 1.6% growth expected by the International Monetary Fund for Angola next year. And that's it on the program. Thank you very much for watching. I'm Chimezi Obi Iwago.